right, thank you for joining us today. And my name is Mansi. I'm a partner with PwC Southeast Asia Consulting, focused very much on digital transformation and business model reinvention. So today we'll be talking about open banking and how it is enabling open finance and open economy, and in turn creating new business models like banking as a service, cards as a service, digital banking, and all by means of democratizing customer data in a secure manner, democratizing products and payments. So before we get started, I'll just share some statistics that shed light on how big a growth we are going to see in this space. So market for embedded finance applications is projected to grow to 250 billion by 2032. Branchless neobanks and digitally agile insurers are estimated to reach global transaction volume of 600 billion by 2026, and digital payments market in Southeast Asia is projected to reach 700 billion in 2024. So we are talking very large numbers. And if we look at big tech like Apple Pay, Google Pay, and Alipay, they have accumulated over 3.2 billion users. So the opportunity is huge, and we are going to discuss today how banks, fintechs, and payments players and other startups are looking at creating the best out of this opportunity. So starting with Mike. So audax has been at the forefront of banking as a service. So how does banking as a service help traditional banks transform? And can you share specific examples of the impact it has had in markets?
Yeah, so banking as a service has been around in a number of flavors for about 6-7 years. Distributed finance, loan channeling, and there's been a few flavors and models of banking as a service as well, where the bank would expose its balance sheet to a third-party provider to provide the technology rails to deliver these financial products to third parties. The challenge with that was the banks themselves had little control of the risk, little control of the regulation that was being applied by the third party, which fundamentally meant controls became problematic. And we saw some examples of this fall down in the last year, really. I think the most prevalent one was Synapse in the US, where they were a middleman banking as a service provider, and they were not responsible, shall we say, in the way that they managed their risk, in the way that they managed their compliance, and it resulted in them actually folding earlier this year, with a lot of customers having their personal positions exposed and at risk. The reason why that kind of existed was the reason why the middleman existed was there wasn't really the right technology available for banks to deliver banking as a service themselves. That is no longer the case. There's a number of providers out there providing the technology capabilities, audax included, but there's also a number of banks who are just building that service as it is. So they become a headless financial organization where they own the balance sheet, they own the regulation, they own the risk, but they are completely headless. They have no branch, they have no brand, and they allow a third party to distribute on their behalf. This has a huge benefit for particularly banks that have potentially been struggling, and also new entrants, because one of the largest costs for a bank is customer acquisition, the CAC. And if you can reduce your CAC, you've taken away a huge layer of your operational expense. It's also then, if you can reduce your operational expense, allows you to open up a whole new market demographic. And this is what we saw in Indonesia. Before we were audax, we were Standard Chartered Nexus. We were the business and technology arm of the banking as a service business of the bank. And we deployed the technology in the business into Standard Chartered's Indonesia business, where they're a subsidized bank, 1% market share. And their customer acquisition cost is in the hundreds of dollars. And Indonesia as a market demographic has only got so many wealth or affluent customers. If you want to deliver mass market, you need to have a very low customer acquisition cost because the customers themselves are not going to derive a lot of revenue. So taking banking as a service as an approach enabled Standard Chartered to engage with a whole new market demographic, engage with them 100% digitally, got 300 million people, tens of thousands of islands, a branch system, a branch network is very expensive. And by engaging with these customers via a distributor, an e-commerce provider, a fintech, it enables them to acquire the customers on the bank's behalf with a significantly lower customer acquisition cost. So for Standard Chartered doing this, it actually reduced their CAC by about 95%, which meant you can target a whole new customer base for services, be it CASA, be it revolving line of credit, be it cards. And these are all kind of flavors of banking as a service. They're financial products. So the opportunity there is huge. For Standard Chartered, it increased their customer base 4x in 6 months, albeit with a lower cost, a lower revenue per customer. But it really enabled them to scale quickly without the corresponding cost of acquisition. So if you fast forward that model, taking accounts, taking lending, taking cards, how do you then apply that in different use cases, different markets with the same effectiveness? And we see a huge opportunity there, be it in an evolving market like Indonesia or a mature market like the UAE, of where the customer doesn't need to engage directly with the bank. They have a relationship with a third party that they already trust, and they can then acquire the financial product they need within that ecosystem. And a very good example of that, if you think about it, is the old adage of the co-brand with an airline or with a retailer, where the bank themselves was still responsible for a lot of the acquisition, and they were directly responsible for the technology. In the new paradigm, you can actually push a lot of the actual customer acquisition and the customer experience to the co-brand, to the retailer. And this cards as a service paradigm, and particularly in that space, we see a huge, huge opportunity.
Thanks for that, Mike. But that really brings us to the question on cards as a service. So Ben, how do you see cards as a service enabling this opportunity and opening up the markets for financial institutions and banks?
Yeah, that was a very smooth segue. So obviously,
almost like it was rehearsed.
I know. It could have been a script, maybe. So obviously in the cards business, for our issuing banks, cost of acquisition is a big challenge. Technology and keeping up with the technology and digital demands of consumers is also a huge challenge. You know, many of our issuing banks and acquiring banks are running on legacy stacks with software that is usually not from one single source. So software running cash systems, software running card systems, and indeed many different services that are providing things like KYC, that are providing digital identity, that are providing fraud management, and data protection, etc., which is becoming increasingly important. So we're seeing cards as a service provider, and not just audax, there are quite a few who are providing this, as a means by which we can provide card services in a more agile fashion. Our customers, whether they're traditional issuers, can experiment. So what we're seeing increasingly is that customers will take a certain segment, particularly Gen Y, Gen Z, Gen X segments, for example, who have high expectations of digital experiences, and they're looking to experiment and perhaps be able to provide a unique product proposition to those user bases. And often they'll be looking at a cards as a service provider so that they can do that in a very agile, very responsive, A/B testing manner. And we're seeing demand for that. We're also seeing demand for increasing amounts, and Mike mentioned this, co-brands. So co-brand partners and neobanks who want to spin up services very quickly. They can provide a large user base in many aspects. So we're seeing the traditional guys like the airlines, the hotel groups, and now e-commerce players coming in with co-brand requirements, and cost there is increasingly a factor because you're increasingly sharing the proceeds from these issuing deals with more than just a couple of mouths to feed. So cards as a service, absolutely something that we're very focused on, working with partners, because we don't actually as a scheme deliver these capabilities. What we are increasingly doing is we're baking in a lot of our services and capabilities into platforms such as audax so that we can provide the full stack of capabilities. So one recent example that we're rolling out is passkeys, so passkeys for payments, as well as a lot of the capabilities that you will expect now in digital native environments, such as easy and simple provisioning into the XPays, simple provisioning of card credentials, and indeed any payment credentials into other digital wallets, and also into e-commerce merchants.
Thanks, Ben. Now, with that, innovation in the cards as a service, banking as a service, collectively disrupting financial services as a whole, Manoj, as a traditional bank, what are some of the challenges you see in adopting open banking?
First, I wouldn't call ourselves traditional, but I think we are innovating. But innovation within banks is at times slow. But let me just sort of give a little bit of context about Abu Dhabi Islamic Bank, because a lot of people probably never heard of it. We're the fifth largest bank in UAE. We have about 70 billion in assets. We're the third largest Islamic bank in the world. And Islamic banking is very much about being Sharia compliant, but effectively offering the same set of services to customers, right? So we've got about 1.4 million customers using our app, and we've got about 60 odd branches in UAE. We've also got presence in other GCC countries, and continue to grow that. I think I just wanted to kind of take a step back. The whole idea of open banking and open finance was started from a consumer perspective, right? It was not intended for banks to drive their monetization. It was about consumers being able to get the best services across their relationships, and the best services across different financial institutions or product providers in a single place, right? That was sort of the intention of how open banking started with Australia, and then embraced by UK, Singapore, and then I think UAE is definitely a very fast follower in terms of embracing that. So the initiative in the UAE is called Open Finance, and I think it's in the infancy stages. So there are two challenges to it to answer the question. The first challenge is agreeing on the integration standards and frameworks in terms of what exchange of information is going to happen. Open banking is only as good as the security and trust it has. So regulators are very particular in making sure that that sort of trust framework is well established. So that takes a little bit of getting all the banks and institutions to sort of comply with that. And then the rollout of the capabilities is over time. So I think it's still fairly nascent. But within the bank itself, I think there are multiple challenges, right? One is, we do have a legacy stack. So being able to provide these services through the legacy stack means there's a level of modernization that needs to happen. But I think the step one of that modernization is to bring that into your own app capability, so you can provide the services to your customers. And then the second part is providing it onto the open finance framework for other banks to consume and for you to consume data from them, right? So I think that's one part of the challenge. The second part is, it's about, the cloud enables you. So cloud is not moving to the cloud is not a differentiator or a must-do, but it's basically a fast enabler, right? So that's the other part that we are sort of really taking on. So within the bank, we're driving the transformation of our internal systems. We're moving to the cloud, which allows us to be enabling ourselves faster. And the third part is we're basically looking at fintech partners. We're looking at partners that can drive enablement faster for us to provide these services. And then also we're looking at fintech partners in terms of that can be consuming our services, right? So one of the directions within the bank is, we're not going to become, the manufacturer of every product and service that we need to provide our customer, right? We own the customer, we own the relationship, we own the experience. But the product universe that we want to provide them can be from multiple different areas. So that's sort of the whole integration of bringing that service into our ecosystem is something that we are sort of undertaking. And then, as Mike was talking about, it's also pushing out our capabilities where we don't own the consumer, but we want to provide our services. So kind of providing that in an embedded finance model or in a banking as a service model. So we're kind of driving a lot of those in parallel.
That's really exciting. Thanks for sharing that. And linked to that is, do you also see a little bit of cultural shift within the organization, moving from the existing legacy ways of doing to more innovative, fast-paced, and taking much more digital products or creating new revenue streams? So seems to be different mindsets.
Yeah, I mean, from that perspective, yes, the bank is traditional. Even though it's 25 years old, it's been, there are cultural nuances that come into existence. There's also about, the one thing for our bank is we're never going to go branchless because our consumers and customers actually want to come to a branch. That's why we've got a network of 62 branches in UAE. Because, every time you think about, the customer wants to come in, wants to talk to his or her relationship manager, wants to have that coffee, wants to have a view on their investments or products and services. So I don't think that's going to change. But within the bank, to deliver this in an accelerated way, yes, moving to agile ways of working is something that every institution is embracing. The question is how far and how extensive it is. For us, we're still, in somewhere in the middle for us to sort of drive that. So that's one part of it. The other part about it is explaining and understanding, how embedded finance works. How do you make revenue by pushing your product and service? How do you, also it's the mindset shift about not every product and service has to be your own. You still own the experience. So I think that's done by bringing in new people, new thinking into the organization, which is what the bank has started to do to sort of drive that change and shift. So it's going to be, it's slow, but I think it's progressing. I think the first part of it is, the key part for us right now is just to make sure that we can continue to increase the assets that we currently have our existing customer base, not going after new to bank customers, but just sort of growing our net new money with the existing to bank. So that's sort of our focus at the moment.
Thanks for sharing that. And if I flip the question around, more from Audex's perspective, so Mike, a similar question. You have experience scaling solutions and banks are your clients. So how do you overcome resistance in adopting, from banks, in adopting digital, scalable digital solutions?
So interestingly enough, the biggest competitor to us is typically the bank itself. A non-progressive CIO would be, is typically where the challenge lies, is somebody embracing change. And unless they're willing to embrace change, you've got a seriously uphill struggle to deal with. And quite often, the challenge they then say is, right, we want to fix our digital front ends, and I just want a new app. Well, anyone can build an app, but how do you build it and own it? And when you own it, I mean, how do you operate it in life? Because you can build it and spin it up, but how do you then manage change? And that's the underlying biggest cost that a bank will face, is change. Not just the cost of change of the technology, but the cost of not making change to how you treat your customers. To Manoj's point, you're trying to farm your existing customer base in a finite market, that the UAE. Well, unless you can evolve and change to your customers' needs quickly, you're not going to farm them. You're not going to get them to invest more in you. So that's kind of the biggest piece of resistance we see in the market. The next piece you really see is how the regulator reacts to the change that the bank wants to apply as well. So once you've overcome the bank, once you've engaged your progressive bank that wants to make change, that wants to make a difference, what is the impact that they then have to, how do they work with the regulator to convince the regulator that this change is good and it's within the domain and the reasonableness of the regulation, or how do they then influence the regulator to actually apply change as well themselves? So this is the underlying challenge I think we face in this industry, and it's where any new modern banking organization is facing the challenge. The incumbents are there, and it's very hard to move them, because once you're in, it's very difficult for a bank to take it out. Even if it's bad, even if they have a poor relationship with the technology, it's very, very difficult to extract. As Ben was mentioning, you've got a lot of tech debt in there that's just difficult to unwind. So it is a competitive landscape. There is a lot of companies out there doing similar things to what we're doing. I believe there's enough pie for quite a lot of players, and there are different ways that this could be deployed in different markets. If you can get the right progressive banking organization, supported by the right regulatory framework, I think it's a path for success.
I'm just going to ask both of you a question here, and this was unscripted, but I do like to throw grenades now and then. I think it's not just a question of being progressive in terms of the technology, it's and the regulation, but I think as well, what I've seen and encountered, particularly among incumbent banks, is challenges around the ownership of the consumer and the ownership of the underlying data, the consumer's data. And you know, a good example of this where I think banks find themselves challenged over the consumer ownership is the XPays. Apple, Google, Samsung, basically being the digital front end to the payment experience. And I know a number of banks who have issue with that, not just because they have to pay the XPays some money, but because essentially they're being disintermediated from their consumer. And I think we're increasingly seeing this in, you know, so I'm interested to get your perspective, particularly Manoj, as an issuer, and as an owner of that consumer relationship. How do you feel about the potential for disintermediation? Is that something that you take on that challenge and you see that as an opportunity to extend your services, or is that something where you see the bank as having difficulty in terms of mindset change?
I mean, I think it's a great question, Ben. I think it's two different parts of the thinking. One is, I think it's an opportunity. One from the fact that we want to kind of be in the embedded finance business. So we have to think of it that way, where we will not own the consumer, and we want to provide that as a service, similar to, you know, to the example that you were stating, where, you know, we get disintermediated and the customer and you know, Google Pay or Apple Pay effectively own the payment rail, and we're part and parcel of it. So I think they're distinct and different, but if we want to kind of be on the embedded finance side, then we've got to embrace the other. And then I think the way we're sort of looking at it is, I don't think we have an option. You know, we can't dictate what the customer wants to do, because today's customer will do what they feel. Every customer is multi-bank, right? If they don't get those sort of services from you, they're going to get it from somewhere else. So you either, a good example is virtual cards, right? The issuance of virtual cards. You know, if you're not fast enough to be able to embrace that, be able to support it, then they're going to go somewhere else who is going to be able to do that today. If you're not going to be able to provide them the payment rails to do remittances across where they want to send their money, and you tell them how it works, they're going to go somewhere else, right? Because there's always a new emerging bank that comes up, and in our region, in UAE, it's exactly that, right? So Rio Bank, Live Bank are two examples where they basically set the standards of pace, and everyone else is just every other bank is just sort of scrambling to kind of reach to that experience. So I think banks realize it. Do they like to? I think the whole open finance conversation is a not everyone's running to the gates to sort of embrace that, because they don't want to exchange information about their customers to anyone else, because their customer acquisition cost is so high and they don't want to share that. But I think the consumer is going to force it.
And from that data ownership point of view, do you see, is this a generational shift or a cultural shift of acceptance of where data can be shared and who actually owns the data themselves? Because a scheme can say, well, we own the data, but it was generated by the consumer. So who has that right to monetize the data in that regard?
Yeah, I mean, I think if you look at different generations, look at it differently, right? Now, if you look at the pure balances, look at your transaction information, consumers are less wary about it. But when you start to look at wealth information, it's a different story, right? And there have been a lot of use cases when it comes to open finance as well, right? Being able to do portfolio consolidation, be able to take your multiple assets, bring that into one. Actually, consumers are like, no, I don't want that. I don't want that capability where you're going to give me, and I'm going to be able to share information about my one relationship I have with, say, UBS versus with the Bank of Singapore. I keep those accounts separate. I don't want my RMs to know it, and I have that relationship for different reasons. Whereas it comes to basic retail banking transaction information, I think they're less fussed about it. Now, probably, the Gen Alpha are not going to care as much. Maybe the Gen Y probably would care because of all the scams, etc. So they don't really know in terms of how that data is being protected. So I think each generation has a different view and look at it.
Yeah, I think Gen Alpha just wants a bank of TikTok or a bank of Minecraft. Something like that. But maybe that's something you guys should do.
But I mean, I guess if you think about open banking as if we rewind as you were saying at the beginning, it was somewhat altruistic of how do you create a framework for data to be shared. But banks, schemes, and plenty of other parties want to monetize it as well. As you're stepping away from banking as a service and moving back into what open banking is today, does it create in its current form an opportunity for you or a threat for you?
Definitely an opportunity for us. We need to encourage new entrants in this space, particularly as we look at the mass segments of the markets and the emerging markets, whether it's South Asia, whether it's Southeast Asia, the hundreds of millions of underbanked or unbanked consumers who we want to be using our products, but to date have been difficult to reach and access because of the cost of acquisition and the cost of managing those consumers. If we can bring down that cost and use other non-traditional parties to reach those consumers and embed our products within that, that's a huge opportunity for us. And also, I would just say part of Mastercard's DNA in terms of doing well by doing good. We have a lot of focus on the unbanked and the underbanked population in terms of including them in the formal financial sector. So it's also part of our mission statement.
Yeah, I mean, just one last point on that, right? I think I've seen this at HSBC and I'm seeing this at my current bank too. It's treated as a regulatory initiative. It's not treated as a revenue initiative, right? So the mindset shift, I think, to your question, Mansi, is we're all embracing it because the regulators are pushing us to do so. We're not doing it because we're seeing the revenue opportunity. I think the revenue opportunity still has to come. But I think it's so nascent right now, and just the basic foundation that needs to be sort of laid out. But I think the opportunity is quite large.
In the interest of time, wanted to open up the floor for any questions.
I have one. I think I liked your point on where you're talking about the technology adoption being largely driven by the regulatory push versus the revenue push, right? So what is that one thing the traditional bank would do differently if the regulations were a lot easier?
Yeah, I think it is, as soon as it actually helps their digital product P&L, then I think they sort of will start to embrace that a lot more. Where other banks are very willing to embed the services of your bank, so or the products of your bank, right? So I think that's where the shift and the mindset shift would basically be realized that this is a unique opportunity to not own the customer. And I think embedded finance is happening, and it's not happening in the banking world. It's happening in the consumer world, right? Where you can basically, through, WeChat is a great example of where embedded finance has sort of really established itself. And I think that's when, people recognize that opportunity, but I don't think embedded finance to me is actually an open banking play. It's about having the ability to have open APIs to embed in other products and services where you can sell your own, right? So I think there are going to be steps to this. I think the regulators have to kind of create standards not only about how data exchange is going to happen, but how services are going to get monetized, right? So people don't feel that their customers getting cannibalized. So I think there is a bit of that journey. I don't think I haven't seen any regulator crack that as yet.
And one last question we had over there.
I have a question about open banking. You mentioned that you see opportunities in open banking. However, based on the European experience, we have seen that successful stories we have only when centralized initiatives have been imposed to the market. Even though there is a standard created in the European Union, there are problems faced in the open banking functioning. Do you think that this should be regulated by the authorities, or the market should by itself create standard, like in case of card industry, that they have created standard by itself? Because it's very technical to a certain extent for a regulator to create such standards.
You're both looking at me, so
Cards,
yes, cards. Yes, I did hear cards. I'm not an expert on the European banking scene or open banking scene, but from what I have seen from the activities that we've undertaken, I don't think there is yet a killer app in the open banking environment in Europe. I'm not sure that there will be one. Certainly what has been regulated in terms of opening up transactional data and also payment triggers, as I said, I don't think we've yet to see a killer app. In terms of how that should be regulated, I think the European Union probably has enough regulation for now, and I think this should be driven by the market, driven by consumer needs, and if necessary, authorities can step in, but I think the parties in the ecosystem are generally responsible and responsive to consumer needs. And I think most successful applications in the payment space have been driven by private organizations recognizing a need from consumers and delivering on that need.
Any further thoughts before we wrap up this? Oh, there is one more question.
I wanted to ask one question of mine. So you said there are three players: the bank, the middleman, and the e-commerce partner. Now, security being a risk, who decides on the spend on
So that was a model of banking services, and it's not actually a model that I'm a proponent of. I think it's fraught with risk, to your point on security. I think the model is where the bank itself is the beholder of its own destiny in that regard. So it's managing its own regulatory responsibilities, it's managing its own risk, it's managing its own security. It's on the bank to distribute those financial services in a secure manner, using the regulation that actually exists already. This is another challenge we see of regulators, and I don't want to say overreach, I think that's too strong a word, but regulators looking at how do we regulate the space. Well, actually, sometimes you don't need to regulate it anymore. There's enough controls in there. And if the bank as a regulated entity has the cybersecurity policies in place per regulation, it's on the bank to make sure that if they do provide a distributed finance service, that those regulatory framework that they are beholden to is extended to the third party themselves, by themselves.
All right, we are at the top of the hour. Thank you very much. Really interesting conversation. Great to hear about ADIB's initiatives, and Mike for sharing on how you penetrated Indonesia and expanded there, and on initiatives at Mastercard, and how you're collaborating with the likes of audax and the banks. So very insightful conversation, and obviously the question on data remains open, and maybe we'll come back to it at the next panel. So thank you very much for your time this morning, and have a good day and enjoy the rest of the sessions today.
Thanks, Mansi.
Thanks, Mansi.